Hi everybody, my name is Mary Redmond. I'm talking right now about the Australian dollar US dollar pair. So I like this pair along with the other commodity based US dollar pairs such as New Zealand dollar US dollar to the downside. I'm already short this pair. I was last week, and I'm thinking about adding to this position because it broke below an important support level, which is 104.5. You can see that that level is a pivot point, and it's been holding for several weeks now. And since it's breaking below that on Sunday night, it's probably going to be a harbinger for this week. And what we're seeing now, what we began to see last week after the Fed meeting, and what we're starting to see is a transitionary phase in the market to one that's going to be moved towards risk aversion, probably a bigger pullback in the stock market and a rally in the dollar on the anticipation of the end of quantitative easing. So when Mr. Bernanke spoke last week, he made it pretty clear that they're not going to be getting any third round of quantitative easing, at least not right away, because the circumstances are very different from the circumstances of last summer, August 2010, when the Fed decided to do this. And I think a lot of market participants may have been anticipating that they would move right away to quantitative easing round number 3, and so this may have been something of a shock to the markets. But what's perhaps just as important for the Asian currencies is what's going on not only with the European bond yields spiking, but also with the Chinese, the equivalent of their LIBOR at the Shanghai interbank overnight rate, spiking up to the biggest rise in 5 months. So this is something that I was certainly wasn't talking about the SHIBOR rate, but I've been looking at the fact that the Chinese were raising reserve requirements and interest rates extremely aggressively over the last 10 months. And since October of 2010, they've raised the reserve requirements on their banks 9 times. And the market had been continuing to shrug that off. Well, that is not going to continue. And what we're seeing now is a tightening of credit and a removal of liquidity in the Asian markets. So this is pretty disturbing for the Asian-based currencies, and this could mean a real change of trend, because if the Chinese economy slows down, the housing market makes some type of a significant slowdown, it's going to decrease the demand for commodities from Australia. And in addition, Australia itself is suffering something of a slowdown, although the government has downplayed this to a degree. The housing prices in Australia, particularly among luxury homes, have taken a turn for the worse. There's going to be another indicator out this week of Australia, RIS house prices, so that's going to be an important one to watch. But what's important in the stock markets is the S&P 500 is making a serious downward channel now, and we're seeing that risk aversion is rising. It's not going to be completely clear if we're going into a more severe or prolonged downward trend in the stock market. That might not be clear until the earnings start to be reported early in July. But for now, what you want to keep an eye on is a break below the S&P's 200-day moving average, which would come in right about here, and a break to the 1250 level. So on Friday, we saw what was its classic bear market move. The market opened lower, it tried to rally around midday, and then it sold off. So it's probably going to open lower on Monday. And we're also seeing an important rise and a move up in the volatility index, which has really been extraordinarily low for several months. It's been trending lower after the spike up in the VIX, which occurred following the Japanese earthquake. It was relatively short-lived, and the VIX went back down again. But now we can see that it's trending upward. So we're seeing that fear is rising in the market. And this may be happening because of the situation. Well, obviously the situation in China affects the Asian currencies, but we're also seeing a big spike up in the European bond yields. And nobody knows exactly what's going to happen there because the situation in Europe is really touch and go for the moment for some of these countries. And of course there's a lot of different speculation about what's going to happen in terms of defaults. Is Greece going to default, or is this going to spread? And since nobody really knows, that adds to the fear. Gold made an important move to the downside and broke out of its upward channel this week. And copper has also been trending as if it's going in a downward channel. So these are all harbingers which really don't look good for the Australian dollar. And what I'm looking at now, you can see this is also copper. But what I like to look at for the different technical indicators, we're still kind of stuck in this Ichimoku cloud here. This is an important cluster area. There's a lot of support here. If it breaks below this, which looks like it's the 1035 level, then we can assume that we're in an intermediate downward trend on the Australian dollar. And we did see a bearish cross here. We saw a bearish cross in some of the other indicators. The MACD is moving down. The regular relative strength index is moving down. And you see a confluence of these indicators is moving lower, and you also see confirmation in the volatility index and the S&P. Then it's reasonable to assume that the Australian dollar is probably going to have further to fall earlier in the week, particularly since it broke below the 1045 level. So as I'm saying, I'm also additionally short here, and I think I would probably consider adding to this position, particularly another break below 1035, because there's market participants are starting to recognize the headwinds that are coming not only from Europe but also from Asia, and we could be seeing a significant slowdown and a removal of liquidity in the Asian economies, which would only add to the fear factor in the market. So that's why I'm looking at the Australian dollar, US dollar short.